Welcome back. In this session, we will discuss the weighted average cost of capital, WACC. So WACC equal WD times RD times 1 minus tax ratio plus WSTD times RSTD times 1 minus tax plus WPS times RPS plus WS times RS. So this WD means weights of the long-term debt. WSTD equal weights of short-term debt. WPS equal weights of preferred stock. WS equal weights of common equity. RD equal before tax cost of long-term debt. RSTD is before tax cost of the short-term debt. RPS cost of preferred stock. RS cost of common equity. T is tax rate. So in previous session, we studied how we measure cost of common equity, cost of preferred stock, and cost of the debt, long-term debt, and short-term debt. So let's use our tax example. So let's look at here. So to illustrate, we first note that MicroDrive has target capital structure calling for 20% long-term debt, 4% short-term debt, 2% preferred stock, 74% common equity. So MicroDrive before tax cost of long-term debt is 10%. Its before tax cost of short-term debt is 8%. Its cost of preferred stock is 7.15%. Its cost of common equity is 13%. And marginal tax rate is 25%. So what is MicroDrive weighted average cost of capital? So using the equation, we can find out 11.51%. So this means that on average, MicroDrive must earn at least 11.51% on its investment to satisfy all its investors, such as debt holders, preferred stockholders, and common equity holders. So when estimating companies' cost of capital, it is crucial to focus on the current market condition rather than past interest rates or historical investors' expectation. So in this session, we will discuss two important concepts that influence financial decision-making. First is marginal rate versus historical rate. Second is the target rate versus the annual financing choice. So investors, whether existing shareholders or new ones, always base their required return on market current condition, not the past rate. So this means that all investors, whether they bought the share last year or today, have the same required return, which reflects present day risk. The same logic applies to bondholders. Their required return aligned with the current yield on the firm's debt, not that yield at the time they originally invested. So now let's consider the common mistake in financial decision-making, using only the cost of one type of financing to evaluate the project. So for example, the company might say, just example, so our after-tax cost of debt is 5%, our WACC is 10%, and our cost of equity is 14%. So since we were financing with only that, this year we should evaluate the project at just 5% cost. But this logic is flawed in two major reasons. So first thing is adjusting lower cost of debt can hurt the future's investment decision. So suppose the firm take one project earning 5.1%, just slightly above its cost of debt. Next year, if it runs out cheap debt and must raise equity, it may have to reject the project earning 13.9%, which is just below its 14% of cost of equity. So this distorts investment decision and prevents the firm from maximizing long-term value. And second thing is, all investors have a claim on the cash flow. So when firm raise debt for a project, new debt holders don't just have a right to the project cash flow. they have a claim on firm's overall cash flow, including those from the existing and future project. Otherwise, existing shareholders and bondholders also have a stake in both new and old projects. So because of this shared responsibility, all projects should be evaluated using the firm's WACC, not just cost of the financing used that years. Okay, so next slide is explained for understanding protection cost. So protection costs refer to fee and expense associated with issuing new security, and they are significantly higher for equity than for debt. So why? Because that is typically sold in large block to institutional investor, so it can reduce the cost. But STAR, on the other hand, is sold in small amount to many investors, so increasing expense for investment bank, which pass those costs on to the company. So additionally, stock value are harder to estimate than that value. So this makes the process of issuing STAR more expensive and difficult. So let's estimate the cost of a new common equity. So for the firm using the constant growth model, okay, so we assume for this firm has constant growth. So we can use this formula, very familiar with the formula we studied already in previous session. So in this part, we should adjust for the flotation cost. So RE is the cost of a new common equity. D1 is expected dividend next year. So F is flotation cost the percentage. So D1 over P0 times 1 minus F and plus the GL is the growth rate. So most of analysts use usually the CPM to estimate the cost of equity. But how do we adjust it for flotation cost? So if a firm dividend growth method give cost of retained earning at 11.1%, and the cost of a new external equity is 11.9%, then flotation cost at 0.8% point to the cost of equity. So to adjust the CPM estimate, we just simply add this 0.8% to the calculated CPM return. So instead of adjusting the cost of equity, some firms just treat flotation cost as one-time negative cash flow in their project analysis. So this approach considers flotation cost as an initial expense when evaluating new investment. Sometimes it makes sense. Okay, let's move on the next part. Okay, so far we have focused on publicly traded firm when discuss the cost of capital. But what about the private owned firm and small business? Since their stars aren't public traded, estimating their cost of equity require different approaches. So today we will discuss two common methods and important adjustment for the liquidity. Okay, so first is comparison approach. So in public firm, we use stock price and return to estimate the beta for CPM model and dividend growth approach to measure required return. But how do we estimate cost of equity for firm without the stock price? So here is the solution. First, identify public trade firm in the same industry and very similar size, and then estimate their beta and take average beta as approximation for the private owned firm. Finally, use this beta in CPM formula to estimate the firm's cost of equity. Okay, secondly, own bond yield plus judgmental risk premium approach. So another method is the own bond yield plus risk premium approach. So this is a simple but effective way to estimate the cost of equity. So based on this idea that equity should have a higher return than that due to some higher risk. So formula is RS equal RD plus judgmental risk premium. So this RS is cost of common equity, RD is cost of debt, judgmental risk premium. Typically, 3% to 5%. So why use this approach? Because it is simple. It doesn't require market data like a stock price or beta. So it is useful for a firm with limited access to financial market comparison. So one major difference between public and private firm is liquidity. So rather than its level, right? So since private firms are uneasily bought and sold and trade not too much, so investors demand liquidity premium, just like they do for thinly traded bonds.